is one of our highest rated webinars and highest registered webinars we've had. So we're looking forward to presenting this information to you. We're going to, address a lot of great information. We'll address COVID-19. We'll address, the economy, everything. So I think you'll really, it'll be really helpful in your decision making and deciding whether this is a good project for you to invest in. Okay. So with that, guys, I think we'll get started. We have a good amount of investors on the webinar right now, so welcome. As I mentioned, Ravi and I are going to present about our latest acquisition and our latest project. It's called the Griffin at Petworth Metro. This is our first project. We've been waiting almost 2 years to find something of value in Washington, D.C. And this was a year in the making, this project, and we're super excited to present this to you. And again, as I mentioned, this has gotten a significant amount of popularity, even though we have investors from Hawaii all the way down to the Florida Keys and everywhere in between. This project in DC is going to definitely resonate not only to most people in the country, but also to our local DC, Virginia, and Maryland investors that we have. And so again, we're very excited to present this information to you. We're going to add more detail than what we've sent out in the investment packet. And I'm also going to address the gorilla in the room. I know what you're all thinking about. What's going on with COVID? What's going on? Is this the right time to invest? All of that. And we'll give you an honest and transparent appraisal of what we've sensed is going on. And this is based on talking to economists, the top multifamily syndicators in the country. This is based on our own experience of our portfolio. Again, this is going to be our 13th acquisition. So again, we've really been in the trenches and we understand, and we have a pulse on not only just the regional real estate markets, but the national real estate markets. So I'm going to go ahead and go to the next slide here. So our goal, guys, tonight is I'm going to make sure we're very concise, to the point, get you the information you need, and so you guys can get back to your families and get back to your evening. So we'll do a quick intro. We're going to talk about COVID-19 and its effect on commercial real estate. We'll have a quick executive summary. I'll talk about the property in general. We'll discuss Petworth submarket of DC and how it's located in a prime path of progress, and about the strength of the DC employment market, the DC economy, and how it's one of the strongest and most powerful MSAs, which is metropolitan statistical areas in the country. And if that wasn't enough, obviously we'll discuss Amazon HQ2 and the amazing impact it's going to have on the local DC economy. We'll talk about the business plan, a little bit about the phenomenal debt we got on this deal. We'll discuss the financial analysis and how you're going to get your returns and your appreciation and profit. We'll discuss the multiple exit strategies and the one we chose and why we chose that. We'll talk about the management company, and obviously we'll end with a little bit about Viking and our track record. Okay. And again, if you have any questions, guys, I want this to be, conversational. I want this to be open and transparent. So please drop it in the chat box below. And again, Alicia's going to be manning that for us. And then we'll address some of those questions. And I guarantee you, we'll probably address 95% of them in this presentation. Okay, so a quick intro. Again, our team of Viking Capital, these are our 4 principal members, but we have an extended team of almost, 8 to 10 individuals that work all over the country in Viking Capital. We have $313 million of assets under management. We've purchased over 2,600 units with ourselves and our partners. And I want to introduce who I am. Again, my name is Vikram Raya. I am a resident of Virginia, of DC. So this is very close to us in terms of geographic location. I'm a cardiologist. I practiced up till 2018. I've moved on to real estate full time. I do own 2 successful health optimization clinics that are running very well. I've been investing in real estate since 2012 in single family homes, and then in about 3 years from that time period, I moved on to some retail spaces. And then in 2015, Ravi and I decided to really go full force into multifamily, and we formed Viking Capital. And we've had an excellent track record. We've done 12 acquisitions. This will be our 13th. We've had a significant track record because we've had 5 successful exits. And now, we really are excited about this opportunity that, that we're in right now. This is the next 2008. The people who bought real estate from 2009, 10, 11, 12, 13, they're the millionaires right now. And so we're right now, this is our opportunity to really, double, triple our portfolio. And we're really excited to do that. Back to something personally, as I mentioned, I live here in Fairfax in Virginia. I have two amazing kids, Veer and Armand. They're 7 and 9. So we're doing the homeschooling thing just like you guys are. My wife, Mona, she is amazing. She's on the front line in the hospital. She's a rheumatologist. She's seeing COVID patients. And so, I really admire her for all her hard work. And, I'm just excited to, share this project with you guys. I think being in the B+A asset class is the way to go in this part of the economic cycle. And with that, I want to send it over to my good friend and partner in this project, Ravi Gupta.
Thanks, Vikram. Thanks everyone for joining. I'm really honored and appreciative of you spending your evenings with us this evening. Excited about this project as well. It's right in our backyard. It's in a place that we know very well and I've invested in personally. So just a bit about me. I grew up in this area, went to high school here, and went to school in Virginia. And then in 2005, moved back to this area. And when I got married in 2009, my wife and I were looking for a place to live, and we wanted to live in DC. So we ended up buying a multi-unit property in DC in DuPont. It was a 3-unit property. We lived in 1 unit and rented the other 2. And it was so lucrative for us that we decided to buy another, and then we bought 2 more. So we understand this market very well. We bought in Northwest DC, very close to this current property, the Griffin. And that allowed us to partially pull back clinically. She's also a rheumatologist. Interestingly, both our wives are rheumatologists. Since then, in 2015, when Vikram mentioned that we started Viking Capital, I also pulled back from working full-time as a hospitalist and just work in the hospital more as a passion project of mine. I still enjoy it. I still like going in there to see patients, but most of my time is spent on Viking Capital. I'm excited about this project, very excited about this project in particular. As Vikram mentioned, it's been years in the making. We've been trying to get into this DC market because it's so difficult, but it's so desirable. And we'll talk a lot more about that during this presentation. So once again, very glad you're joining us, and we're gonna continue onward.
Thank you, Ravi. So I want to introduce you to 2 key associates of ours. One is our newest team member, Judah Fuld. He is one of our most coveted members of our team. He joined us recently, and he is a lawyer. He has extensive experience in equity and capital and in the multifamily markets. And again, he's going to be a dynamic part of our team as we really rev up our acquisition cycle starting in 2021 and beyond. And then I cannot mention enough one of the core members of our team, Alicia Galloway. She is a stalwart in helping us fundamentally take care of asset management, investor relationships. She's our social media person, and she's the glue that keeps one of our organizations together. So again, hats off to Alicia for propelling Viking Capital to the status it is now. And again, guys, we have a very deep bench. We have legal representation. We have some of the top attorneys who are part of our SEC team. We have relationship with the top property management companies in each market that we operate in. We also have, again, contractors, vendors, construction crew that we work with. And so whatever we're doing, we have an extensive background and team in. So why do we like this deal? Here's my top 5s. The debt is amazing. It's HUD debt. For those of you who don't know, HUD is housing, urban development. This debt is very difficult to get. You have to get approved. It took us almost 6 to 8 months to get approval of this debt. And it's the reason why everyone wants to go through the hassle and the pain is because it's so amazing. We're getting a rate of 3.2% for 35 years, right? And again, this is sort of unheard of. And so that's why The debt on this deal is amazing. It's essentially free money, right? And number two, the location in DC. And I say DC specifically because this is the most resilient and recession resistant city in the US. And I have data to back that up. Number three, we're getting a 2.5x multiple for our investors, for our limited partners on this deal. And how do you get that on an A-class deal? And then we've come up with some amazing strategies with our exit options. And so it's such a powerful return for such a safe investment. And that's why I like it. And finally, the last 2 points are, it's near a metro station, which in DC, for those who know, it's like gold. And the final one is the submarket called Petworth, where we're investing in, is one of the most up and coming areas of DC. And there are areas that have already exploded, like where the National Stadium, the Wharf, and things like that. Many people predict Petworth is that next area. And so again, we're very excited about the location. And then I'm gonna let Ravi discuss his reasons for why this is such a good deal.
Thanks, Vic. My reasons for liking this deal are similar to Vic's. I have some additional ones, but I could really go on and on about this. And I don't say this about all projects. This deal in particular is one I'm incredibly excited about. The location, location. It's cliche, but in this example, in this asset, it's very true. It's located in a tier 1 city, Washington, D.C. It's the most protected and recession-resistant city, as Vic mentioned, in the U.S. Also, Petworth itself is transitioning to be the new hotspot in DC. When I used to live in DC, I remember, going out when I first moved here. DuPont was the place to be. Then it started moving over to Shaw, and then it started going up northwest and into other places in DC. But really now, Petworth is starting to become the hotspot. A lot of millennials are moving in that area. It's sort of like a hipster, new age type location. Appeals to single folks as well as families. The housing in that area has blown up. I mean, housing prices have doubled in 1.5 years, 2 years almost. The location also is important in that the metro, as Vic mentioned, is literally right next to the property. I mean, you walk out the door, make a left turn, you walk less than a block, you're at the metro station. It's super important. There's a Safeway and a Starbucks right across the street. So people like living in a place where you can get groceries, you can, get to work. It's all in the same location. You go to restaurants, you can go to bars, you can go out. I mean, it's all there. You can walk to all these locations. So that's huge and that's key. The second reason I like it is because of the $7.8 million of intrinsic value. What I mean by this is if you took the property today and converted it into condos, and look at what the condo prices are currently, you could sell this property for $7.8 million more than what we're buying it for. It already has that value intrinsically in there. Now, obviously that's not going to happen at this point. It's not the market for it. We also, because of this hot debt, we've got a step down penalty that we're going to talk more about later, but it takes about 6 to 7 years for that to burn off. Doesn't make sense to do that now, but it has that value there. Also, there's no rent control. A lot of assets in DC, as people know, they're rent control assets. You can only increase by 4%. Because this asset was built after, I think it's year 2000, there's no rent control there. So that's huge. It's a new construction product, no deferred maintenance. And on top of that, it is an Energy Star building. And this is, as many of you know, a big project of mine is green construction, green building, environmental sustainability. This is another reason I'm incredibly excited about it. It's an Energy Star building, and in fact, we're going to talk more about this later. We've partnered with another company called Zone, where we are playing the energy market. The way we're doing that is we're putting thermostats in each unit, and also on the each of the water heaters, and we're turning off power with the residents' permission. Of course, they can opt in, opt out. We're turning off power certain peak demand times, and we can save a significant amount of money doing this. In fact, the residents get paid for this. We get paid at a minimum of $5,000 per year. And also we get all this equipment to do this for free. it's a great market to play this kind of play in the energy field. And another reason that I like the deal, there is also operational upside. The current owners are operating it a little heavily because they are a big company. They don't specialize in property management. We are using Borger Management, a third-party property management company. They actually manage several deals several units right next to ours. The building, just the sister building of this one, actually just a couple doors down, they manage. So they're going to manage all this together. So we get the efficiencies of managing a large complex in this in sort of a smaller complex of 49 units. The other reason is it's a building in a B+ and A area in a tier 1 city. It's really, these are the type of assets you want to buy in this economy. And finally, the HUD loan is something that you really can't beat. Vikram already mentioned that. That's another reason I like it.
All right, great, Ravi, thank you. So guys, it's a no-brainer. We need to discuss COVID-19. We need to discuss the multifamily. We need to discuss the recession. So, why are we buying now? Is it the right time? What's going on with real estate? Should we just keep our money under our mattress? Should we invest in the market? Should we just be in cash? What's going on? So, number one is we want to avoid panic, right? This downturn will obviously not last forever, and an economic rebound will occur. And I'll give you an example. Both foreign American businesses in China are ramping back up. Patience is the key. Smart investments in the long term will get you, outsized returns. And so we know that in 2008, 2009, DC did quite well. So if history is of any teller of the truth, then we think that DC again will do very well during this economy. And I'm not investing all my money in real estate, but I'm definitely investing a portion of my money in real estate. So diversification is the key. So if all you're doing is investing in the stocks, you're at the whim of the market, which, as you can see, can be really rapid up and down. And the latest data from some of the top, hedge fund managers, private equity groups, and some of the top financial experts is saying we haven't seen the bottom of the market yet. They're thinking maybe in August. So again, guys, having something in a diversified scenario is ideal. And I'll show you an example of that over the last 20 years. Let's talk about real estate as being a safe haven. Again, this is a hedge against inflation, and during times of global volatility, investors should have confidence in real estate, especially if it's the right opportunity. If you look at vacancy by class, over the last 20 years, again, it's been a slow downward trend. We have becoming a renter nation, and millennials don't want to buy houses. People in the older brackets, when they downsize, they want to, again, live in apartments or condos, and it's less and less home ownership is going on. And so you can see here, it doesn't matter what asset class, the vacancy, what type of class of apartments, vacancy, again, has been consistently low. Obviously, we're monitoring everything right now. We have properties in Atlanta, Dallas, Austin, Tyler, Texas, and now, we're going to have something here in DC. And we're going to be monitoring everything very closely, and we're doing our best to help our residents, help our tenants, navigate through this. But why I like multifamily is think about it this: everyone needs a place to live. They don't necessarily have to go to a hotel, which is hotels. That's why they're being crushed right now. They don't necessarily have to have office space. A lot of people are teleworking, so office space is being at risk. Retail, people are going buying online, so you don't need as many retail spaces. But what you always need is a place to live, a roof over your head, and hence that's why multifamily will be the safest, most protected asset class among real estate. And again, as I'm mentioning, there's a more and more of a gap between apartment rent and home payments, and that's why, again, people will still find that living in apartments is the way to go. The second part is the kind of renters we have in our particular project, the Griffin. They are, they have more affluence, they are more considered white collar, and they are less at risk for these kind of volatilities in the job market, and they have more likely to have savings and stability in funds. And the final thing is, since 2000, they've done numerous studies comparing the S&P and real estate, and I'm specifically talking about commercial real estate. And so if using the 20% rule where you invest at least 20% into alternatives like multifamily and real estate, here's the graph. From the year 2000 to year 2019, they took the National Property Index and compared it to the S&P. And so basically, this is a person who invested entirely in stocks versus at least 20% in commercial real estate. And you can see the trends. Over the 20 years, real estate outperforms pure equity markets. And again, this is specific commercial real estate. Another powerful piece of data within Washington, D.C. You can see here that it's one of the top 10 metros. And number two, the percent growth is still there. And again, this last piece of data is one of the strongest. I think we're getting a couple of questions about the HUD, and then we'll discuss that in a second. But let me just keep moving here. DC is considered the most resilient metro. This is from Yardi Matrix. They're the ones who manage, all the multifamilies all over the country. Their software manages that. So they have access to significant amount of statistics. And so they're saying of the top 50 metros, this is basically the top 50 cities and secondary tier cities, who is at high risk because of COVID, because of social distancing, because of quarantines, because of things not opening up. Like Orlando, it's getting crushed because one, no one's going to go to theme parks, right? Think about Vegas. There's no conferences. There's no hotels being used. So that's why they're at much higher risk. The Florida coast, right? And then if you look at it, even, there's other cities and they make the full rankings. But when you go down and you look at it, Washington, D.C. has less than 25% of its jobs at risk, okay? And that's because it's pretty obvious. Majority of DC's jobs are government, or they're Fortune 500 companies who are intrinsically related to the government. And so it's very protected. And then throw in Amazon, and again, it's almost a recession-proof city. And here's the data saying only less than 25% of DC jobs are at risk. And when I mean DC, I mean DC, Virginia, Maryland, okay? The DMV area. And here's another piece of information. Right now, like I'm talking about 2 weeks ago, when we got on the phone with our brokers and we're saying, hey, look, here's the deal, what's going on, we're ready to move forward. And they're like, well, if you don't want to move forward, guess what? I have Chinese and Israeli buyers who want to buy your deal, Petworth at Pennington right now. So that's the kind of languaging we're getting from our brokers. And this is because they're looking for safe havens of where to put their money. There's still a ton of equity out there. It's all sitting on the sidelines, but they need a place to park it. And so again, real estate markets in the US are a safe place. And within the US, obviously the DC is one of the safest. And so foreign buyers love investing in DC.
Yeah, just to add to that, Vikram, that a lot we hear from our broker, and this happens very often, is that Chinese, Israeli, Russian buyers that want to put their money in something safe are looking for, tier 1 city investments. And DC is really a hot spot because of all the reasons we mentioned earlier. In this particular deal, we had, when we were talking about, moving forward and how things are going to look in the future, our broker told us, listen, if you don't want this, if you decide to move on, we have people that will pay more than what you have it under contract for to get it right now, because they're hedging against inflation. Everybody knows it's going to happen. There's trillions of more dollars floating around. People want to hedge against this. So it was reassuring that, this is what's going on right now in DC.
All right, guys, here's my legal disclaimer. Okay. This is an investment. Obviously there's risk, all of that. So my legal team is requiring me to say it. So I said it, but here's a good thing. This is an institutional quality asset. Okay. So our exit strategy will have a ton of buyers. If again, selling this in like a Charlotte or a smaller tier city, it would have been much more difficult. But when in a tier 1 gateway city with hundreds of buyers who want to buy this level of an A-class asset, it's not going to be a problem. Again, for the sake of time, we're going to move through this more rapidly, and then we will also answer those questions. Keep the questions coming in. Thank you for asking them. Alicia Galloway, our team member, is manning those, and then I'll address some of those at the end. Again, 49-unit A-class high-rise building, core plus asset, built in 2011. Again, with a consistent of 1 and 2 bedrooms. there is a whole wave of restaurants, attractions over the last 24 months. It's nearby anchor retail, including Safeway and Starbucks, luxury quality finishes, zoned as condos, built as condos, run as apartments, because the developer felt that that was the right move at that time. And so 49 units, as I mentioned, we're buying it for a little bit over 390K a door. Again, the whole period is seven years, and we'll discuss some of the finances in a second. So here's an example of some of the retail that's all very close by. Average square foot is about 838 square feet. Another added bonus, many buildings like this do not have parking spaces. We have 25 underground and surface parking spaces. There's stainless steel appliances, upgraded fixtures. I mean, this is really a high-end property. I would assume many of you would want to live in this kind of property if you had to choose to buy a condo. Plank wood flooring, Zodiac quartz countertops. I mean, they did not spare any expense when they created this condo apartments. Amazon hub, concierge service, roof decks on the penthouse units. It really is a top-of-line product. Here's examples of some of the finishings and some of the pictures. You can see the beautiful, gorgeous views here. Again, private rooftop terraces, full-size washer and dryers inside, hardwood floors, honed marble tile. So again, a very premium product, located again right next to the metro. I want to emphasize the zoning. This was built as condos, and it has something called a shelf condos designation. And so when the decision comes for us to convert this to condos, which is one of our primary exit options, a lot of the work has already been done for us. So literally we just have to do some more of the paperwork and move it toward that condo designation. Here's some of the submarket. Again, restaurants, shops, eateries. The walk score is very high. I think it's 25. Again, 17 new bars and restaurants. Very hip, very exciting, very millennial friendly, and it's attracting more and more residents. And the growth of the Petworth submarket has increased dramatically. As you can see here, Georgia Avenue is a street where our building is located, and you can see it's all the different restaurants, shops, bars that have developed in the last 24 months here. So this is really what we call in real estate a developmental path, or the path of progress. And if you remember when Ravi said he's been monitoring the success of the different neighborhoods in DC, well, 14th Street is just about 2 streets to the left of where we are, and that's already blown up. That is having the highest and the best quality restaurants in DC are located on 14th Street. And so we're just 2 streets away from all that. So this is the Google Maps I did today because I wanted to really show you some amazing pieces of data on Petworth and on DC. So as you know, Washington, DC is 10 square miles. And within 10 square miles is packed with employers, restaurants, retail, shopping, transportation, jobs, employment. And here's some of the statistics. That you can see my pointer here, and this is where the Griffin apartments at Petworth Metro are. Now, just 9 miles away from this is Amazon HQ2. Okay, so that's just literally across this bridge right here. The Pentagon is right near where the Amazon HQ2 is. Let me see if I can annotate this for you here, guys. All right, guys, you can see this here. So this is the Griffin, that's the Pentagon, and this is where Amazon HQ2 is. Okay, this, guys, is where Georgetown is. That's only 8 miles away. I'm sorry, 5 miles away, Georgetown. This is the White House. It's 3 miles from our property. And Washington Hospital Center, which is one of the best and top hospitals, especially for cardiac and other situations, is only 1.7 miles away. And also MedStar is one of the top employers in this area. I think they have almost, I have to look at the exact numbers. It's probably on a slide later, but I think they have 17,000 employees. So it's one of the huge employment hubs as well. So again, guys, in terms of employment, in terms of strength of positioning, in terms of dynamic growth, you cannot find a better place than what we're showing you right now.
And just to add to that, Georgia Avenue itself is actually undergoing a rapid transition where the Griffin is located. And recently the city was looking for a street to actually shut down for certain festivals. You know how DC has every season, they have different types of festivals where they're shut down streets and have parades and such. And actually Georgia Avenue was chosen this last year to have a particular festival, and they actually shut it down. And it just goes to show how popular this area is. People wanted to go to that area. They wanted to visit the different stores and shops and see the parades and such in that area. So it's becoming, as we mentioned earlier, more and more popular. The growth has been moving upward. It's going from Columbia Heights now, which is the kind of the millennial hangout right now. It's going up to Petworth, and it's only going to grow. And
in terms of DC as a strength of a market, again, you can sort of see here the kind of employment here. These are Fortune 500 companies that have found their base here in DC or the DC metro area. Freddie Mac, $74 billion company. General Dynamics, $31 billion. Capital One Financial, $30 billion. Northrop Grumman. I mean, the list goes on. So these are the powerful companies and employers that are located here. And many of these are related to the government in some shape, way, or form. And so essentially, their jobs are going to stay. Here's in terms of the employers, I mentioned MedStar Health, which is located 1.7 miles from our property, 17,000 employees, one of the top healthcare providers in that region. Marriott Hotels, 16,000 employees. Innova, 16,000. Booz Allen Hamilton, a global technology firm that's connected with the government, 15,000. University of Maryland, 14,000. Giant Foods, 10,000. Deloitte, one of the top consulting and accounting firms, almost 10,000 employees. So again, jobs is not an issue. And so again, here's pictures of some of the up and coming restaurants, sort of the markets, the grocery stores, all of it within walking distance. Here's the metro station, which is again, highly desirable. It adds an immense amount of value. It actually, raises the value of the property significantly. So the fact that it's just literally across the street, see, this is our property here, the high-rise building, and here's the metro. So literally you can throw a football there. Market overview, as I mentioned, growth here. In terms of population growth, from 2009, population grew from like 2.85 million up to now it's about 3.3 million. Unemployment, obviously before COVID, these are the numbers. It is about 4%. We'll see what happens, obviously with COVID. It may tick up a little bit, but it will definitely be better than the national average. Some of the key industries here, again, professional businesses, government, the labor force we talked about, the education, highly educated population, median household income, about 77,000. Young group of people, 37.4 is the average age. Again, 9 miles from our property is Amazon HQ2. It should have a multiplier effect. So every one job that Amazon brings in, there's going to, because it's the high level jobs, these are $150,000 salary jobs. There's going to have a 5x multiplier effect. So there's going to be like the secondary jobs and the tertiary jobs and the other jobs that are created from this growth. And so it was countries all over the cities all over the country were competing for this. And then again, it landed in DC. So we mentioned the population growth, the MSA being very popular. Let's talk about our particular submarket, which is Petworth. As you can see here, the population has increased. It's about 18,000. Is one of the more popular places to live as the growth continues. The income distribution there, you can see here, it's starting to shift and skew more toward the higher income folks. Again, the average age is probably between 25 to about 45. So again, a younger kind of population, employed, has salary, which is what we want to be resilient in this kind of economy and to be able to pay rent on time and, enjoy living in this kind of building. Purchase price of this property, $19.125 million. Again, if we wanted to buy it even right now, even during this recession, I don't think we could get it for that price. We're buying it for $390K a door, and I'll show you how, based on the sales comps, this is actually somewhat of a discount. Again, there's no rent control, which is very powerful. And here's the breakdowns of the bedrooms. Okay. And you can see here, there's at least 7 penthouses, 14 2-bedrooms, 11 1-bedrooms with dens, 16 1-bedrooms, and then 1 studio. Again, significant amount of community amenities. Thank you again for asking those questions, guys. I'll be getting them a little bit later when we talk about some of the investment highlights. But let me just get through a couple more pieces of information here. Again, underground spaces, the Amazon hub here where you can get packages, the concierge service. We got bikes that are available there. Again, it's a pet-friendly community. So we really attract sort of the best of the best kind of tenants. This is what the lobby of the Griffin looks like. Again, gorgeous, very trendy, very opulent. And again, we're going to attract a higher level of tenants. And so we want to highlight, again, the HUD debt near major shopping centers, the metro, and then obviously the condo quality, plus the energy efficiency. So let's talk about the business plan here. Ravi, do you want to take this on and sort of share with the audience really what we're going to do to really up-level this deal?
Absolutely. So the business plan is very simple. This is a low maintenance, or there's no deferred maintenance on this project. So really, it's going to be, and it's a very nice looking complex, as you saw in the pictures. We're going to enhance some of the units. There are 10 units that have half baths where we can convert them to full baths. We've actually already looked at the blueprints and determined if we could do that, and it turns out we can. So that's a very simple add-on, and adding a full bath to a unit adds value right there, right away. We're also going to add backsplashes to the kitchens, upgrade fixtures and lightings to the common areas. We're going to explore high-speed internet as a possibility. We're also going to add some smart thermostats and things, as I mentioned. There's going to be no cost to us to do that. As far as the green energy improvements, this is the part that I'm again super excited about. We're partnering with Zohm, they are going to provide free to us the thermostats for the regular thermostats, and also for the hot water heaters, and also an AI device that they will attach to the building that will help us play in the energy market. So as the peak demand hits, we will drop the temperatures of the tenants' units, if they opt in to do this, by a couple degrees, and that will save us, it turns out, tremendous amounts of money. And we're going to share in those profits up to $5,000 per year after year one. Year one there's no profits because they're paying for all of our equipment. We didn't put this into underwriting, but it's something that we're doing. We're also partnering with Clean Choice Energy, or we're working on a partnership with them, so that we could potentially make the whole building green. So it's gonna be energy from sustainable sources. We're gonna be playing in energy markets, and we're really at the forefront of technology and sustainability. We've got, in terms of operations, we've got Borger Management that we're very excited to partner with. A management company is so important in any deal. We actually vetted 7 to 8 different management companies thoroughly, and we decided on Borger because they are the most robust. They are actually, as I mentioned earlier, they manage buildings right next to us, so we can get that economies of scale in a building that has less than 100 units, which is typical where you have management that is in-house. The HUD loan we already mentioned, and the exit strategy Vic already discussed, and that in a nutshell is our business plan.
And again, this is just the extra $5,000 a year we're going to generate in savings that will happen after year one. So again, we're trying to be cutting edge in every kind of project we do, and so this is no different. In terms of the debt, it is a HUD debt. It is assumed debt, so we have to go through a loan assumption. The rate is 3.2%. It is a 35-year amortized loan, and again, this allows us multiple exit options. We can just hold on to this long term and run this property, And maybe in year 4, 5, 6, whatever we choose to, we can refinance all the investors in terms of their principal. We can all enjoy this property long term. We found the second strategy of the condo conversion to be the most highest yield in terms of return on investment and in terms of equity multiples. And then obviously we can even just run it just as apartments as well. So there's multiple exit options because of this debt. And again, it's very difficult to assume. You have to be a top-notch operator, and you have to, you know, the finances of the deal have to also work, and both were obviously met in this scenario.
And just to put some color and perspective on that debt, the typical term for this type of asset is 7 years. You know, people go from 5 years, some even 3 years prior to this recession hitting, 3 years, 5 years, 7 years, maximum 10 years, you know, maybe 12. You'll see a few at 12. 35 years is really unheard of. So this puts us in a position where we can hold on to this property if there's any concerns about market fluctuations. You know, anything happens in the future, we can hold on to this as long as we need to. And you imagine the other operators where, you know, after 3 to 5 years, which will happen, you know, for some may happen like, you know, this year or next year, that have secured those types of debt, they have to refinance or they have to sell. You know, they're in a position where they have no choice. This is a very conservative play because we have, you know, basically, you know, a huge amount of time to make a decision. And like, that's why we really like this HUD debt. Another reason we like this HUD debt.
And there's a prepayment penalty. It does step down from 7% when we're acquiring it down to 0 by the end of year 7. There's also the LTV, loan to value ratio. It's 75%. Here's our main exit strategy, which is the condo conversion timeline. So normally we as Viking have consistently been doing apartments and just routinely running them as apartments using a typical value add strategy. And then we exit and we take advantage of the appreciation and the cash flow. This is a very unique situation because the quality of the units are condo built quality. It's also zoned as condos and it's located in one of the top condo markets in the country. It only makes sense to consider this as an option. And once we explored it further, got specialized consultants, did a thorough underwriting and analysis, and sort of stress tested that against even a recession, which we anticipated even before COVID happened. We had built in our assumptions to have a recession. This exit strategy still yields 2.5x multiple. And so how it's going to work is this. We're acquiring it right now for about $390K a door. And if we turn it around right away and sold as condos, we could sell it easily on average each unit for $550K. So again, that 7.8 million we mentioned in the past. If we operate as apartments, which we plan to do from year 1 to year 5, we're going to generate a significant amount of cash flow. And then our plan is at the end of year 5, we're going to convert the HUD loan debt to bridge debt. And with that money, the value is obviously increased. We're going to refinance out 20% of the money and pay off some of the investor principal. And the remaining amount will allow us to then, because as a HUD debt, you're not allowed to sell as condo. So by converting to the bridge debt, we will then subsequently sell over the next 24 months all the condo units. And full sellout will happen in year 7, where then we'll pay out any remaining principal owed and obviously the appreciation for the waterfall structure. And the waterfall structure we'll discuss in a second, but it is an 80-20 split with the limited partners getting 80%. And on top of that, they're going to get a 7% pref return, which they'll be getting cash flow through year 5. And then obviously with the refinance, they'll be made whole and some of the principal will come back to them as well. So let's get into the financial strategies. As I mentioned, the highest return on investment and the highest rate of return is doing the condo level exit. However, if we decided not to do the condos for any reason, the equity multiple just as an apartments is also very attractive. It's 2x multiple. So again, almost a 20, I don't know how the exact numbers, I believe it's like 21, 22% annualized return just running it as apartments. And so again, and as Viking Capital, we believe in multiple exit strategies, multiple options, conservative approach with the highest ROI for our investors and for ourselves. The IRR on this deal is 16%. The equity multiple, as I mentioned, is 2.5x. The cash on cash return is 5.4%. However, there's a 7% pref, so that will be made whole before any equity waterfall is done. The average annualized return is 25.7%. Here's how the capital stack works. The HUD debt we're assuming is 13.8 million. And then between the GPs and the LPs, we'll be bringing to the table 7 million. So the cap rate adjusted is a 5 cap rate, which is very difficult to find in DC. The purchase price, again, is 19 million. The loan amount is 14 million. The equity required is about 7 million. I mentioned already the returns. And here's the actual condo prices. We did a market survey the last 2 to 3 months, and per unit prices right now are 469, 506, 655, 835. So this is what the condo prices are right now in 2020. And we just put a very conservative 2% rent growth for the next 7 years. And this is what we plan as an exit. And that's what we're using as our calculations. In terms of the equity, we have the down payment, we have our renovation project, we have closing costs, we have the syndication fee, we have the broker fees. In terms of the project budget, the interior renovations are about 47,000. The bathroom updates about 48,000. We have a contingency for any unknown things that come up, whether it's new improvements, whether it's repairs, which we expect minimal because, again, this is a 2011 built building. And again, there will be less repairs or things that we need to take care of. The common areas are 38,000. We've reserved for that. And this is how the cash flow is going to work for the limited partner. So a sample investment of $100,000. In year 0, you see your $100,000 being invested. And here's the cash on cash return. And it steadily increases. And again, this is a cumulative cash on cash return. And it increases. And then in year 5, we have the refinance. And then you have a large lump sum coming out. You got $10,000 of pref cash flow. And you get $18,000 of your principal back as well. And then in year 6, you're getting the 7% as we convert to you doing the condo sales. So for $100,000 investment at the beginning, you get a $246,000 as your final end sum. And you can see here, year 1, 2, 3, 4, 5, 6, 7. This is now if it makes sense to do the refinance earlier, we will consider that as well as the condo sales. Now, I think this might be a good time where I can answer a lot of the questions that you may have, guys. So let's see. So here's some of the questions here, and I want to answer them so you guys feel comfortable here. I may have missed this. Does the Griffin currently have tenants? Yes, the Griffin is currently leased up completely. It's 95% leased. Another question was, how long has this property been on the market before Viking bought it? Again, it was off market for a while, and then we had first access to it, and then before it came on the market. So we were pretty much early access to this deal, and it was due to our broker relationships is how we were able to get this project. And then let me tackle some of these chat questions here. Hello guys, does a HUD loan have some provisions regarding some of the rentals for low-income tenants? This particular property does not have any rent control, so we don't have to worry about low-income tenants. Okay, so great.
Just to add to the question about the property being in the market, we did have an off-market viewing because of our relationships, our broker relationships. They put it on the market, and it was on the market for approximately 4 to 6 months. They had 17 offers on the property. They chose us because we just clicked with the seller. We had a really nice conversation with them. Our actual offer price was actually less than others. So even though we didn't offer as much, they still awarded us the property. So we were, it was nice to know that we got it at the price we wanted it at and that made the most sense to us. And it was actually not the highest bid on there.
So let's talk about the pro forma. And so what we've done, guys, is year one and year two, we've put in year one, essentially no growth. And we start near the tail end of year two, we actually start doing a little bit of rent growth based on the value add we're putting into the property, operational efficiencies, et cetera. But we're really not counting as much of rent increase as the reason why the income goes up. And so this is a conservative, especially in DC market, where we expect rent probably after 12 months to start rising. And another powerful piece of information is the previous owner has not done significant rent increase for the last 4 years. And so there is, we are far below our competitors in terms of rent comps.
Just to clarify that, it's actually, they haven't increased rent in 3 years, and we will not increase rent for another year. So it'll be 4 years of no rent increase.
Yeah, thank you for that clarification. And the other powerful thing is the break-even analysis. Again, we would have to drop to almost 30% vacancy for us to be even concerned about not being able to make our mortgage payments. So again, very powerful in terms of the strength of the property. And again, as you can see here, year one, year two, very flat. And then year three, year four, we start increasing our rents. And again, year five, at the end of year five is a refinance, where a partial return of principal to the investors, also a preferential return catch up. And then obviously the condo sales, where significant amount of the equity appreciation will be realized. And in terms of expense ratios, because this is a brand new condo unit, we expect very limited expenses. But even though that is normally the case, we've considered any possible expenses and tried to sort of inflate the expenses as much as we can. But we're still running at about a 34 to 35% expense ratio.
And this was based on input from Borger Management as well. So we went over all the expenses with them in detail, and these are the numbers we came out with.
So here you can see the rent comps. The average rent per square foot, this is our subject property, $2.70. And you can see here all the other properties nearby. There's 1, 2, 3, 4, 5, 6 properties here, and then 2 more a little further away. But you can see most of them have significant higher rents than we do. So the average effective rent for us is about $2,377. It's not as high as compared to a lot of our competitors. And then if you look at the average rent per square foot, again, we're the very lowest. And again, right now in April, our occupancy was 95%. So despite the COVID, despite the recession, despite whatever else is going on, this property still seems to be performing. And we were actually looking for any reason to retrade, to negotiate again with the seller, to try to like get discounts to do that. He goes, look, I have several people ready to buy this property right now. And essentially we didn't have much in terms of ammunition to retrade. So in a way, that's a good thing, because this shows the robustness of the deal.
So when we also spoke with the property manager about collections in the property, currently they have 95% collections, and there are two tenants that will make themselves whole by the end of this month. So it'll be 100% by the end of the month. We're going to constantly look at this data. I mean, if there's any concern in May, June, we're going to update everybody. But right now, based on what we've heard, it's going to be 100% collections in April at the end of the month. And then we're going to look at May and see how things look then. So we will constantly keep you updated about how the collections are going.
As you can see here, here's all the sales comps in the area. And we used 7 sales comps compared to our property. Here's some of the data that they can sort of visually help decipher some of the information. The average unit price, we paid $390K a door. The average unit price is about $450K a door. So again, a discount was received here by us. Number 2, the price per square foot, again, a lot lower than many of these properties. We are at $341 per square foot. These guys, most of the competitors, if you average them, it's $523 per square foot. So again, we're buying this at a discount. We're having a solid base of tenants. We're in the best city, and we have powerful exit strategies. Here's again the summary: 2.5x equity multiplier, 16% IRR, 25.6% annualized return, $7.8 million of equity upon purchase. Great HUD loan. And again, here there's overall the numbers of the deal. The property management company we chose is Borger Management. They have 7,000 multifamily units. They manage $2.3 million of square feet of commercial and retail space. They've been in the business for many, many, many years, highly respected. They manage some of the buildings nearby. So we've vetted them out and we feel very comfortable with them. And again, this is some of their footprint. We wanted someone local because this is a very unique market, and we wanted someone who's expert in the market, and that Borger Management fit the bill. Maryland, Washington, D.C., Virginia. At least 200 properties, 3 regions, 50 years of experience. A little bit about us. We've talked about us a little bit, but here's, again, our motto. And I added the conservative in there because I really believe in what we're doing is conservative. Focus, conservative investments, accelerated returns, right? This is our portfolio. We're not new to the game. We're established players in the multifamily space. We are not restricted to just one geography, but we've specialized in a couple of different markets. Atlanta has been our top market that we focus on, but obviously Dallas and Austin are very good markets to be in as well. And on top of that, now we're going to add Washington, D.C. to the mix. We have about $313 million of assets under management with ourselves and our partners. Again, about 2,600 units. And here's our 5 exits. We've actually sold the first 5 deals I listed on the previous slide. 20% returns for our investors for Wild Creek, 19% for Villas of South Cobb 1, 19% for Villas of South Cobb 2. And we really hit a home run with Ascent at Riverdale 1 and 2, which we combined as one deal. It was 180 units. We sold that last year. 38% return to our investors. Now, please do not hold us to some of these returns. They're pretty powerful, but again, we feel very comfortable and confident in this deal, and we feel like we can, again, maintain our track record. And so just a little bit about these deals. Again, 242 unit, 1988 B-class property. Again, a 20% return. This is a C-class deal we bought, 1969. Again, complete renovation, 188 units, and again, 19% return. Similar type of deal here. And then again, this is another C deal we bought. As you can see here, we've let go of all our C properties and we've transitioned to just Bs and As. We anticipated this market correction and we were prepared for it by choosing just the best quality assets so we can weather the storm and actually become even more profitable as we come through the tail end of this. So with that, guys, thank you so much. If there's any questions, we'll love to stay on for a little bit longer. Ravi, do you have any closing thoughts?
No, I think we pretty much went through everything that we just, all the questions and all the comments that we were thinking of. I don't think there's anything else that I need to add, but if anybody has any questions, please feel free to put them in the chat box. And I don't see anything. Oh, there's one more that just popped up. And Alicia, if you can put in the chat box, the soft reserves, we're already getting a lot of requests for people to put in some more reserves for this deal. So if you can put the link for the soft reserves in there, and obviously we'll be mailing out the replay and another access point for you guys to put in your reserves. And again, we're here to answer any questions. Our email's below. Ravi and I are always available for you guys. You have our cell phones and our emails, so please feel free to reach out. And again, just for the sake of time, we'll definitely want to make sure we end on time here. I think we have one more question. Let me see here. No, it was a comment.
Okay, great. All right, guys. Well, thank you so much. Enjoy your evenings, and we'll be being in touch soon.